Imagine you want to be a part owner of a giant company like Apple or Reliance. You don't need billions of dollars. You can buy a tiny piece of these companies. These pieces are called stocks or shares. When you buy a stock, you become a shareholder. You own a small part of that business. Owning a stock is exciting. It's like having a ticket to the company's future. As the company grows and makes more money, the value of your stock can go up. You could sell it for a profit. However, if the company doesn't do well, the stock price may drop. Investing in stocks lets you participate in the growth of companies you believe in. It's a way to grow your wealth over the long term. But remember, investing always comes with risks. It's crucial to do your research and invest wisely. Think of stock exchanges like bustling marketplaces, but instead of fruits and vegetables, they trade stocks. Companies list their shares on these exchanges, allowing investors to buy and sell them. In India, two major stock exchanges are the National Stock Exchange, NSE, and the Bombay Stock Exchange, BSE. The NSE is known for its technology, while the BSE has a rich history dating back to the 19th century. The US boasts the world's largest stock exchanges. The New York Stock Exchange, NYSE, is famous for its iconic trading floor. You've probably seen it in movies. Another major US exchange is the Nasdaq, known for listing many technology companies. Not all stocks are created equal. There are two primary types, common and preferred. Common stock is what most people think of when they hear stock. It gives you voting rights in the company. You can have your say in important decisions. Preferred stock is a bit different. It usually doesn't come with voting rights. However, it often pays a fixed dividend. That's a regular payment to shareholders, like getting a small paycheck from your investment. Both common and preferred stocks have their pros and cons. Common stock offers potential for higher returns, but also carries more risk. Preferred stock provides more stability and regular income, but may not grow as much in value. Ready to dip your toes into the stock market? Here are some essential tips for beginners. First, research is your best friend. Don't buy a stock just because everyone is talking about it. Understand the company, its business, and its future prospects. Second, diversify your portfolio. Don't put all your eggs in one basket. Invest in different companies, industries, and asset classes. Diversification helps reduce risk. If one investment performs poorly, others can cushion the blow. Third, think long-term. The stock market can be volatile in the short term, but over the long run it has historically trended upwards. Don't panic sell when the market dips. Stay focused on your investment goals and ride out the fluctuations. Finally, manage your risk. Only invest what you can afford to lose. Start small and gradually increase your investments as you gain experience. Remember, investing is a marathon, not a sprint. Section 5. The power of SIPs, investing made easy. Investing doesn't have to be daunting. SIPs, or systematic investment plans, make it a breeze, especially for beginners. With an SIP, you invest a fixed amount regularly, like monthly or quarterly, into a chosen mutual fund or stock. Think of SIPs like setting up an automatic savings plan. It helps build discipline and consistency in your investing. You don't have to worry about timing the market or making large lump sum investments. SIPs also offer the benefit of rupee cost averaging. When the market is down, you buy more units. When the market is up, you buy fewer units. Over time, this averages out your purchase price, potentially enhancing your returns. Section 6. Diving in, your first steps in the stock market. Ready to take the plunge? Here's your step-by-step guide to getting started. First, open a demat and trading account with a reputable stockbroker. You can choose from traditional brokers or online platforms. Next, link your bank account to your trading account. This enables seamless fund transfers for buying and selling stocks. Now, it's time to familiarize yourself with basic investment terms. Understand concepts like market orders, limit orders, and stop-loss orders. Don't hesitate to use the educational resources provided by your broker. Many platforms offer tutorials, articles, and even virtual trading simulators to practice your skills. Section 7. Blue Chip Beginnings, Starting Safe. As a beginner, it's wise to start your investing journey with blue chip stocks. These are stocks of large, well-established companies with a proven track record of profitability and stability. Think of companies like Reliance, Tata Consultancy Services, TCS, Infosys, or HDFC Bank in India. In the US, blue-chip examples include Apple, Microsoft, Amazon, and Johnson & Johnson. These companies have weathered economic storms and emerged stronger. Investing in blue-chip stocks provides a sense of security and can help build confidence as you gain experience. Remember, diversification is still essential, even within blue-chip stocks. Section 8. Level up your knowledge resources for stock market success. Congratulations on embarking on your stock market journey. Continuous learning is key to success in investing. There are tons of resources available to deepen your knowledge and refine your skills. Explore reputable financial websites like Bloomberg, Reuters, and Money Control for market news, analysis, and educational content. YouTube channels like The Financial Diet, Investopedia, and Wall Street Prep offer engaging videos on various financial topics. For those who prefer reading, consider classic investment books like The Intelligent Investor by Benjamin Graham, One Up on Wall Street by Peter Lynch, and Rich Dad, Poor Dad by Robert Kiyosaki. These books provide timeless investment wisdom and can shape your investing philosophy. Remember, the stock market is a dynamic and ever-evolving landscape. Stay curious, stay informed, and never stop learning.